The warehouse smells of metal and dust. You lift a 500-ounce bar of silver, cold, heavy, solid. Most people see this and think insurance. A hedge, something passive, something that sits quietly while the world hums around it. But quiet is deceptive, because the system is straining. You don't see it yet. Banks, bonds, governments, they all look normal on the surface. Stock tickers keep blinking. Central banks announce rates. Headlines parade fear or hope. Everyone focuses on the obvious. Markets don't fear that, not the headlines. They fear what almost nobody notices. The undercurrent, the slow pressure building beneath. Industrial demand, monetary demand, supply barely growing, debt levels rising, confidence quietly shifting. This bar in your hand, 500 ounces of silver, is no longer just metal. It is a signal. It is where industrial need meets monetary scarcity. And when the system adjusts, it will adjust around assets like this first. You are not holding a passive asset. You are holding participation in a transition, one that starts almost invisible, moves in odd, abrupt waves, tests conviction, rewards understanding. This is where most investors pause. They wait for clarity, but clarity comes too late. The silver market shifted, not violently, but steadily. Prices moved from $24.50 to $25.20 over the last 2 weeks, a gain of roughly 3%. Not extraordinary by historical spikes, but notable in context. Volume picked up. Exchange-traded silver products reported higher inflows. Physical demand at major mints, according to U.S. Mint reports, remained above average for this period. Futures markets showed extended open interest. The COMEX silver contract added about 12,000 lots over the past fortnight, indicating more participants positioning in the near-term delivery cycle. The bid-ask spreads narrowed slightly, suggesting increased liquidity. At the same time, backwardation, where spot prices exceeded future contract prices, appeared intermittently, signaling tighter immediate availability. Global mining output, reported by the Silver Institute, remains constrained. January and February production in top-producing countries, Mexico, Peru, and China, showed minimal change compared to the prior year. New discoveries and expansions remain slow, partly due to environmental and permitting constraints. Industrial demand also continued its gradual rise. Photovoltaic manufacturing and electronics assembly reports indicate steady consumption of refined silver. Telecommunication equipment and renewable energy infrastructure projects, particularly in Asia and Europe, absorbed a measurable portion of available metal. Meanwhile, debt markets and U.S. Treasury yields displayed modest volatility. 10-year Treasury yields moved from 3.75% to 3.88% over the same 2-week period, a moderate increase but enough to affect financing costs broadly. Taken together, the factual picture is simple. Silver prices in early 2026 are moving upward modestly. Trading activity has picked up. Physical and industrial demand remain firm. Supply is constrained. Bond yields are rising slightly. No extreme events triggered the movement. The market adjustments are measured but persistent, reflecting a slowly accumulating set of forces rather than a single headline or shock. The sound of metal sliding across a wooden table. That's silver being counted at a refinery. It feels ordinary, but ordinary hides structure. Rising silver prices aren't just numbers. They reflect pressure building elsewhere. Supply is constrained. Mines produce at roughly the same rate as last year. Permitting delays, energy costs, labor constraints, these are real physical limits. Meanwhile, industrial demand isn't slowing. Solar panels need silver. Electric vehicles need silver. Telecommunications, medical sensors, data centers, they all require it. When supply and demand diverge, prices start whispering. Then they speak. And in a small market like silver, even moderate flows of capital amplify movements. A few thousand new ounces entering ETFs, a handful of institutions increasing allocations, these create ripples that a larger market would barely notice. Here, the ripples become waves. Now consider the monetary dimension. Debt levels in developed economies are historically high. Governments, corporations, and consumers rely on borrowing. Rising interest rates make that borrowing more expensive. Treasury yields creep up. Financing costs rise. Margins compress. Confidence in credit conditions shifts quietly, almost imperceptibly. When confidence wavers, investors start reallocating. Not in panic, slowly, methodically. They seek assets outside traditional credit reliance. Silver sits at the intersection. It is tangible, monetarily recognized, industrially necessary. This duality gives it a unique sensitivity to system-wide tension. Chain reactions appear first in the small corners. Commodity ETFs record inflows. Futures markets tighten. Spot premiums for physical silver increase. Refiners note heavier demand for immediate delivery. Slowly, these movements ripple through broader markets. Small flows of capital test liquidity. If pressure continues, behavior changes accelerate. Positions shift before headlines even exist. The first order effect: silver begins acting less like an industrial commodity and more like a monetary hedge. Investors adjust allocations. Open interest grows. Volatility rises, not from emotion, but from structural imbalance. The second order effect: broader awareness. Hedge funds notice the flows. Central banks monitor industrial and monetary metals. Supply chains feel pressure. Industrial projects adjust purchasing. Even unrelated markets, currencies, bonds, react subtly to this redistribution of attention and capital. In short, modest movements in silver prices are signals of structural dynamics, not anomalies. They reflect supply constraints, rising industrial and monetary demand, and growing attention from capital seeking stability. Understanding these chains matters more than any short-term price chart because they reveal how the system adapts under pressure and where early positioning can influence outcomes before the broader market catches up. London, early 1980s. Silver had just experienced its last major spike. Futures contracts dominated headlines. Paper trading dwarfed physical demand. Small investors got caught chasing momentum. Prices doubled, then collapsed. Lessons were carved into memory. Fast forward to 2026. Some surface patterns feel familiar. Futures markets remain active. ETFs hold significant positions. Physical premiums spike occasionally. But the context differs. Industrial demand today dwarfs what it was 4 decades ago. Solar panels, EV batteries, data centers. None of these existed in 1980. Supply chains are global, yet mining output is constrained by environmental and regulatory hurdles. Another comparison: 2008 to 2009. Financial crisis. Silver moved upwards sharply as investors fled weakening credit markets. Monetary demand surged. Industrial demand dipped briefly, but silver's dual role became visible. The market responded to stress, not hype. Today, stress is more gradual. Debt levels are higher. Interest rates are rising from historic lows. Confidence is eroding quietly. The signals are subtler, cumulative rather than abrupt. History shows patterns of neglect, accumulation, sudden repricing. But scale and structure matter. The silver market is smaller relative to global capital pools than in 1980 or 2008. That means modest shifts in allocation can create outsized price moves. The dynamics are similar in principle: attention, scarcity, dual demand. But the global economy, technological dependence, and interconnected debt markets make this cycle structurally distinct. What history teaches is how markets behave, not what they will do. It shows that early positioning pays off, but timing is unpredictable. It shows that volatility often signals structural change, not failure. It shows that dual-purpose assets, monetary and industrial, gain strategic significance when broader systems are under pressure. Looking back is instructive. Patterns emerge, but the differences: industrial scale, technological integration, debt size, policy complexity, ensure we cannot rely on analogies alone. This is why observing current conditions matters more than projecting prior outcomes. History is a lens, not a map. The refinery smells of smelted silver. Coins clink. Futures contracts flash on screens. Everything hums with quiet tension. Now imagine three paths: conditional, not certain, but plausible. Bull case. If industrial demand continues rising, solar panels, EVs, 5G infrastructure, and mining supply remains constrained, then silver could see sustained upward pressure. If bond yields spike faster than expected, shaking confidence in credit markets, Capital might increasingly seek tangible, dual-purpose assets. If global monetary authorities maintain low intervention in metals markets, allowing scarcity to manifest, then attention could shift rapidly from paper instruments to physical silver. Under these conditions, premiums for immediate delivery could widen. Futures volatility may increase further. Small shifts in institutional allocation could cascade into larger price movements. Early accumulators could benefit disproportionately because the market is relatively small compared to global capital. Base case. If industrial demand continues steadily, but supply adjusts slightly through incremental mining production or recycling, then silver may experience measured gains. Futures markets remain liquid, but backwardation is occasional and minor. If bond markets normalize without extreme shocks, capital reallocation into silver occurs slowly. Prices move in small waves rather than leaps. Physical premiums increase modestly. Volatility remains contained. Early positioning is helpful but not critical. Investors experience gradual repricing, reflecting structural pressures without dramatic shocks. Bear case. If industrial demand slows, solar subsidies cut, EV production constrained, or mining output improves faster than anticipated, then upward pressure may diminish. If central banks intervene aggressively, stabilizing credit markets or offering alternative hedges, then silver may trade more like a regular industrial commodity. If interest rates rise without immediate stress on credit, capital may not shift toward tangible hedges. Prices could stagnate or retreat temporarily. Futures and spot markets may experience volatility from speculative repositioning rather than structural imbalance. Early accumulation provides limited advantage because systemic pressures fail to materialize in this scenario. In each path, notice how cause and effect play out. Supply constraints, industrial demand, bond market signals, and capital flows interact. Not one factor alone dictates the outcome. The difference between bull and base may be subtle, a few thousand ounces entering ETFs or a slight shift in institutional positioning. The difference between base and bear could hinge on policy choices or minor disruptions in industrial demand. Silver does not move linearly. Waves of attention, accumulation, and repricing dominate. Even in the bear scenario, volatility tests conviction. In the bull scenario, small movements can accelerate unexpectedly. The base case is slow, calm, measured, but still directional. The takeaway: conditional thinking matters. Predicting exact outcomes is futile. Understanding interactions and probabilities allows positioning, preparation, and disciplined response. The screen glows, numbers flicker, charts scroll endlessly. But here's what actually matters. Not every headline, not every tweet. Focus. US dollar index DXY. Watch it like a hawk. When the dollar strengthens sharply, silver often stalls. When it softens even slightly, capital flows toward tangible assets. Not dramatic swings, just shifts that nudge allocation decisions. Treasury yields, 10-year and shorter-dated notes. Yields creeping up? That increases borrowing costs. Debt becomes heavier. Institutions reconsider positions. Confidence in leverage wavers. Silver gains attention quietly before broader recognition. Inflation data, CPI/PCE. Track it monthly. Rising numbers don't automatically spike silver, but sustained increases influence central bank behavior. Markets anticipate policy adjustments. Silver's dual demand, industrial and monetary, makes it sensitive to expected changes in real purchasing power. Volume and liquidity, exchanges in physical markets. Open interest in COMEX contracts, ETF inflows and redemptions. These aren't headlines, they're footprints of attention. Spot premiums rising slightly? That's scarcity showing up. Small movements here can signal shifts before the wider market notices. Positioning data. Commitment of traders reports. Large speculative positions. Long-term holders versus short-term participants. The ratio tells you who's participating and how conviction is distributed. Shifts in positioning often precede price adjustments. Quietly. Industrial signals. Solar panel installations, EV production, telecommunications expansion. Physical silver flows into industry. Supply constraints are tangible. They don't always hit the financial news, but they matter. This is where structural pressure originates. I watch these indicators daily, not obsessively, not with emotion. They're data points, clues. Small movements compound over time. Together they tell a story, not the story of headlines, but the story of capital, scarcity, and strategic demand. Focus here, and you see what others miss. Ignore it, and you see only noise. That difference is the early signal versus the late reaction. You set the silver bar down. It's heavy, solid, real. It hasn't changed overnight, but your perspective has. Markets are moving, capital is shifting, supply is constrained, demand is structural, volatility will continue. It always does in transitions. This isn't a panic. It isn't a signal to rush. It's information, observation, understanding. Early positioning matters, but conviction matters more. Watch the indicators, track flows, understand behavior. Let the system reveal itself without forcing a reaction. Silver is more than a metal. It is industrial necessity. It is a monetary hedge. It is a signal of broader system dynamics. Recognize that, respond thoughtfully, and remember, the shift you are witnessing is gradual, cumulative, but decisive when the time comes. This isn't investment advice. It's simply how I'm reading the market right now. Patience, discipline, and observation remain your best tools.